All right, I think we are live, and welcome everyone for joining this Trust Vista Talk webinar. Hopefully everyone enjoyed the long weekend. So as usual, I'll just do a quick introduction and then hand it over to the presenters. Quick background on Trust Vista for those who aren't familiar. We are the leading outsourcing firm for the financial services industry, supporting over 1,000 clients with over 10 trillion in AUM. And we provide skilled outsource support across due diligence, business development, portfolio management, data analytics, and other activities. Feel free to visit our website. And also we have a podcast where we have more in-depth one-on-one conversations that you can access through our website or wherever you access podcasts. So with that, I'll hand it over to the panelists and Abi. Thanks for joining us today. Take it away, folks.
Thank you, Amir. Thank you everyone for joining us. I'm Abilash Jaikumar, co-founder and managing director of Trust Vista. And today I have a great panel of entrepreneurs. I don't want to say emerging managers because they're anything but emerging. We have over 50 years of collective private equity experience on this call. So I'd love it if our panelists could maybe introduce themselves and give a background of their career leading up to the point of launching a fund in the middle of a pandemic. So Annette, maybe you'd like to kick us off?
Sure, happy to go first. And certainly it was not the plan to launch the firm in the midst of the pandemic. But I'm one of the founders and managing partners of MKH Capital Partners. I have 17 years of private equity experience, started my career in New York at what was then JP Morgan Partners. It's now CCMP Capital. And most recently I was at Warburg Pincus, where I spent about 11 years, was a partner there, and invested across industrials, business services, healthcare, and consumer and retail. I had a small stint before starting MKH, which was as a founding partner at Navad Capital Partners last summer. And sadly, our founder passed away, which brought me to the opportunity with MKH, which is a family-backed, Miami-based private equity firm. So we have two primary LPs, the Amzak family office and the Inversiones Bahia family office, who had both been investing together in each other's deals for about 20 years, and were looking for a way to formalize that partnership that had evolved between the two families. And I was connected with them last fall, and my co-managing partner, Miguel Eras, and I partnered with the Moldaz and Kazmas to launch MKH earlier this year. We've already got one portfolio company, which is a platform that we're building in the express car wash space.
Thank you. Pavel?
I am Pavel Chernyshov. I am a founder of ArcView Capital. As Abi said, I think that it's hard to call us emerging managers. I think that it's more appropriate to call us emerging entrepreneurs. So I started my private equity career at KKR. I was making private equity investments on their behalf out of Menlo Park for several years, and then I returned back to East Coast and joined the family office of the Ziff family, Ziff Brothers Investments. And at Ziff, we developed a pretty unique origination strategy. We ended up focusing on capital vacuums, and that really grew into a pretty interesting business. And as some of you know, Ziff Brothers have a long history of backing young, talented managers. And after 10 years of working together with my partners for the Ziffs, we decided to launch our own firm, and the family supported us in doing that, and that's how ArcView came into existence. We've been working together on a number of different transactions, and COVID presented some interesting challenges, but also great opportunities ahead of us, and we're actually pretty excited to be investing in this environment.
Wonderful. Michael?
Oh, thanks, Avi. Good morning, everybody. I'm Michael Kessler. I'm the founder and managing partner of Greens Farms Capital, which was launched only this past July. My background is I was a career investment banker for about 15 years before joining Verona Suler Stevenson and changing into a private equity investor. I spent about 10 years there doing both buyouts as well as non-control investments. And then with 4 friends and colleagues from Varonis, joined the Riverside company to start a new fund on their platform that did exclusively non-controlled transactions. It does seem a little bit odd to embark on this type of a venture during greatest unemployment in recent history and a global pandemic, but you have to seize opportunity when it's there. I was approached by 2 family offices who were interested in expanding their investing capabilities and broadening their capital base. And I was able to create a strategy that I thought had merit both in the crazy competitive environment we've been in, and even during this pandemic. So we launched again in July, and with a focus on the smallest end of middle market, companies less than $5 million of EBITDA. And the strategy there is, it appears to me that as private equity firms have some success, they start raising larger funds, which forces them to do larger deals. And I felt like there was a bit of a void in the market for that sub $5 million EBITDA company. And thus we launched recently and have been pleasantly surprised at the level of opportunity and deal activity. And with the backing of 2 family offices, I have the flexibility of doing both control and non-controlled transactions, which broadens my target universe and also can offer a longer hold period for owner entrepreneurs. So excited about the opportunities despite this crazy environment that we're all in.
Well, congratulations to all of you to taking the plunge. You know, our audience is a mix of GPs, folks who are, you know, independent sponsors thinking about launching funds, and people around the periphery of the private equity industry. Maybe we can start by just talking about what the difference between being a private equity investor is and being an entrepreneur that launches a private equity fund. Right? I think one of the challenges, you know, we work with a lot of emerging managers, and often it's the first time they're launching a business, and it's kind of a rude awakening sometimes about that it's not the same thing, being an investor and being an entrepreneur. So, you know, how would you guys describe the difference in the experience so far?
Or maybe I'll go first, Abhi.
Sure.
So for us, actually, it's been an interesting transition. So I have 2 partners, and at Ziff, in addition to investment responsibilities, each of us had oversight over specific functional area of the firm, and the operations, financial reporting, audit oversight, and HR. And so for us, it's actually been a very good transition because we kind of have seen that how large organizations run, and we got a chance to build our own organization with that operating experience. But it is a very different time split, because I think that we went from 90% searching for opportunities to now have to oversee some of the operations more closely. But, you know, as an emerging manager, you have the benefit of having a very flexible infrastructure, you know, lots of technology and lots of outsourced service providers, which again makes it a very asset-light structure, and I think simplifies the job of launching a fund substantially compared to, let's say, 5 years ago, 10 years ago.
Yeah, so unlike Pavel, my experience had been all on the investing side. So I was purely a deal partner. And I like to tell my friends back at Warburg that I have an incredibly newfound appreciation for the 32nd floor, which is where a lot of the folks across accounting and legal and compliance and fundraising and HR sit. And so I'd say the biggest difference, Abhi, is you have to wear many hats, and all of a sudden you're responsible for things like payroll and business insurance and accounting and expense reports, in addition to obviously looking for new investment opportunities and sourcing deals and trying to be thematic and strategic about where you're spending time and where you're hunting and where you're trying to cultivate relationships. So I think making the plunge, you have to really enjoy that that diversity of the day, and some of it new, and certainly, you know, the nice thing is, as Pavel said, there are a lot of outsourced providers. I think, you know, all of us have been in the industry for a long time, so probably had a lot of people to call to just ask basic questions, and sort of understanding of how firm operations work, and leverage those resources, which I've certainly been very fortunate to have a lot of people along the way who have spent time in firm operations at both large and small firms who've been willing to talk to me about how they are set up, and then, you know, sort of trying to take the best of what I heard from different people and trying to apply that to MKH.
Yeah, I would say that the biggest difference has been trying to learn the business of the business. You know, at Varonis and at the Riverside company, I had the luxury of having a team of 14 professionals source deals for me. I had a full accounting and finance department. We had investor relations departments. All I had to worry about was doing due diligence and underwriting the deals and trying to work with management teams to grow the businesses. I could really focus on just investing. When you're an entrepreneur and a fund manager, you really, I spend time demoing CRM software tools. I have to run down to the bank to make sure wire transfers are sent, you know, as well as maintaining relationships with investment bankers and brokers and lawyers and accountants. So it's really, I would say that sometimes the business of the business is a little bit frustrating because it's new to me. I'm learning, but that's actually part of the fun, is to be learning after working for 35 years is kind of the fun part. You know, I had to learn how to build a website. I had to learn how to do email marketing. Never had to worry about things like that. But it's been fun, interesting, and at times frustrating. But it's very different from the traditional role of just being a professional investor.
You know, when I moved from investment banking to private equity, I thought, you know, I'd be such a better banker now because I know how the buy side thinks. And then I went from private equity starting a business. I thought, you know, I'd be such a better private equity investor now because I know how to call out an entrepreneur's, you know, Excel growth projections. Forget 8% or 10%. Where does 1% growth come from? And all of you have worked at very large organizations and now are focused more in middle market. Do you think this experience is going to actually translate into how you approach diligence, interacting with management teams, and, you know, participating in board meetings when budgets are off?
Yeah, I think that it's again, I think that historically we worked pretty closely with our portfolio companies, and you know, we would get into the nitty-gritty and participate in comp committees and go through pretty detailed budgeting sessions. And so I think we actually get to apply a lot of it to our own business now. So I would actually say that you know, I don't think that our diligence approach will change specifically for ArcView, but I think that we actually get to use a lot of the tools that we use to underwrite companies to build out our own firm. And I'll give you an example, right? So, you know, we come across a lot of businesses that have, you know, on-premise infrastructure and have dedicated IT people, and you know, in many board meetings you ask a question: do you need that? And how much does it cost? And how much time does it take to manage? And you know, so when we were building out our platform, we just went straight to digital first and cloud-based approach, and that's been tremendous. You know, and following our own advice to portfolio companies, we're completely paperless internally. And it's interesting because the case study has been a lot of the advice that we normally would give to our operating companies, we're now implementing ourselves.
You're taking your own medicine.
Exactly right.
Great. You know, I think, Abhi, the fundamental investing skill set translates across any size of company. So I do think for any of us, that piece is certainly very similar. I think what I've found is some of the smaller companies are actually quite welcoming of the experience that I've had with some larger businesses, because that's where they want to get. And they're sort of like, okay, what's best in class that you've seen in some larger businesses, and how can you help me get there, and how can we apply that? And so it's actually been I'd say incredibly helpful to have had that experience. And I think entrepreneurs are appreciative of it. I also think, and the three of us have similar situations where we're backed by families and have a lot of flexibility in terms of how we put the money to work because of our investor base. I found that certainly resonates with entrepreneurs as well, and translating that flexibility and sort of approaching the conversation with what are your goals and how can I help you solve them, rather than, this is my fund structure and how can I fit this investment into my fund structure.
And I would just add that being an entrepreneur and starting a business has just given me newfound appreciation and respect for successful entrepreneurs. Now, I've always had a lot of respect for successful business owners, but now I appreciate all of the work that goes on behind the scenes and behind the numbers. So I think I just have even more respect for and admiration for, and I think it also gives me the ability to understand what they're going through a little bit better. And in the short period of time I've been doing this, I've found that many business owner entrepreneurs have been really interested in my path and why I'm making some of the decisions I'm making with my own business. And it's allowing me to speak to them as a peer, as an entrepreneur, not necessarily as a peer with just having some industry knowledge in the sector they happen to be in.
Yeah, one of the things, when I started as a co-founding partner, and I know Pavel, you've spun out with partners you worked with, and Annette, you started with a partner. Michael, you've had a lot of partners in previous firms. What is the importance of selecting a partner or having partners or not having partners in being an emerging manager?
So that's a great question, Avi, and I think that the answer is a little bit counterintuitive, because I feel like the finance as field in general wants you to believe that one person can do it all. Right? You always read about star managers in the newspaper, and you're always amazed. And maybe it's a little unconventional, but I actually believe investing is purely a team sport, because and maybe I'm not smart enough, but I think it's very difficult for one person to see all the angles and keep all your behavioral biases in check. I think that having, one of the biggest recommendations I can give to people considering setting out on this path is do this with reliable and tested partners that you trust. Because I think that it's critical to have people who will tell you their true opinion and who will call you out on the mistakes you're making and cover your blind spots. And I think that I cannot kind of emphasize enough that I think that the success of a partnership depends on how long you work together before this. Because I think that it's only in tough times can you really see how well you know your partners. And having that experience and doing it with people that you've been through thick and thin, have done investments before and worked through difficult situations is the biggest advantage that I see for ARQ, frankly.
Michael or Annette, would you like to add to that?
Yeah, look, I agree that having a partner is incredibly important for all the reasons Pavel said. And I've always believed, particularly private equity investing, it takes a team. It takes a village to make the investment, and not only make the investment, but create the value and manage it through exit and arrive at a successful exit outcome takes an entire team. So I fully agree, which is why I embarked on this with a partner. My situation was a little bit different, where Miguel and I didn't know each other before. And certainly that risk profile of starting a firm with someone you haven't worked with in the past is different than Pavel's path. The way I handled it was we spent a solid sort of 6 months of real intensive time together, in person, over the phone, over video, all of the above. looking at investment opportunities together, pushing each other, and frankly referencing a ton mutually, because I referenced Miguel a ton and he referenced me certainly a ton. And so I think if you're in the fortunate position that Pavel was in, where you have partners who want to start something with you, that's great. If you're not, there are ways where you can sort of try to accelerate some of that. But I certainly wouldn't do it without a ton of care and caution, and making sure that you and your partner have the same goals and are aligned in what you want to achieve and why you're doing this, and what you hope to get to, and where do you want to see the firm in 5 years or in 10 years, and do you have similar alignment? Do you have complementary skill sets? Do you have complementary networks? Like, how is it that you're going to work together to make the firm a success? And be very, very clear about that up front.
Yeah, in my case, I was fortunate in that the two family offices that are backing me are being run by guys that I've known for over 15 years and had co-invested in deals with previously and sat on boards with. So we knew each other well. We understood how we thought and how we operated. So that made the transition to being partners quite easy, actually. I think having partners and advisors to use as a sounding board is critical, because it's very easy to fall in love with your own deal, and you don't want to lose that objectivity. So in addition to having partners on my investment committee from the two family offices, I also recruited a team of advisors who consists largely of CEOs of my former portfolio companies, who I've developed a lot of a good relationship with, but also a lot of respect, because I recognize that, while I certainly understand finance and accounting and know how to invest, I'm not an operator. And having 3 advisors on my team that are all successful entrepreneurs and operators can give me a view that I simply can't have. And that's been really successful.
Now, switch gears for a second. Just talk about the timing of launching the business. Right now, we're in a downturn, and there's people talk about why there's positives to starting a business in a time like this, and obviously there are negatives to starting a business. Can you maybe talk about the pros and cons that you thought you were going to face and what you've actually experienced? Michael, maybe you want to go first?
Sure. Okay, I can address the pros and cons. The pros are I don't have a legacy portfolio company to deal with, and I know a lot of my friends in private equity are, unfortunately licking their wounds and from this pandemic and dealing with covenant issues with banks through no fault of their own. But second quarter results came out, and many portfolio companies are dealing with bank issues. So I don't have that legacy portfolio to worry about, which I guess is a positive. The other pro is I start with a blank slate, so I can set my own strategy and pursue the type of opportunities that I find interesting and compelling. I would say the cons are it's obviously it's just difficult to conduct appropriate levels of diligence through Zoom, and it works to some degree, but when you're putting your own money at risk, you really want to take a measure of the people you're investing in and be able to have dinner with them and sit with them and understand them, their personalities, and understand them as people, as well as management teams that you're backing. So I would say the biggest significant con is just the environment we're in doesn't lend itself to a normal due diligence process where you really get to establish a relationship with the people you want to invest in.
Yeah, I started Trust 9 months before Lehman Brothers collapsed. So doing a financial services outsourcing business, running into that, in my view is there's one of the positives of this is maybe the expectations for execution aren't necessarily as high. So you can spend a lot more time laying the groundwork for strategy, as you talked about, Michael, to really shape the future. Whereas if times are good, you start a business, all of a sudden you have a flood of deals and you immediately jump into the execution and you put off some of the groundwork of building out CRMs or strategy.
Well, that's actually very true. I mean, we were actually hoping to close the fund in February, and then the pandemic hit, and who knew what was going to happen. So we stopped documentation and everything for several months, which was a little bit concerning. But also, it gave me the time, as you suggested, Abby, to really develop the infrastructure and the systems and choose the CRM and develop all my marketing templates, my legal templates, so I could really hit the ground running when we did launch.
Annette, you were going to say something?
No, I think that's right. That was certainly a pro of having the time. I'd say, you know, one of the other cons, and I'm curious to hear, Pavel and Michael, what you think about this, but I found is, despite the uncertainty in the environment, that a lot of founder entrepreneurs don't want to transact when unless they can get valuation off of 2019. And so having some difficult conversations around, okay, I hear you, but how do we structure that to sort of find a common ground in between, you know, where we are, what we're seeing in the business today versus, you know, what you were hoping to achieve pre-pandemic.
Yeah, I would say that what's been interesting is that I think that we'll only be able to determine whether this was good timing or bad timing in hindsight. I think that it's, you know, with the benefit of hindsight, I think we'll be able to determine that. But I do think that the current environment, I think, tests the strength of the relationships and the networks that we've built as investment executives over the last 15, 20 years. Right, because that's where I think the big differentiation, in my opinion, to kind of sort the successful firms from less successful firms will be how strong is that network, right? Because that's when it's in situations like this, these networks will be tested. And what's interesting to me is that, you know, I hear people draw parallels to the kind of crisis, the global financial crisis. And on the private side in particular, and that goes to Annette's point about people having valuation expectations, I actually think that it takes about 12 to 18 months on the private side for the dislocation to work itself through the kind of the corporate system and also through lending balance sheets, right? Because I think that, you know, no one is really going to serve a dose of reality to businesses because banks are looking the other way. And I think that it really takes 12 months for that to percolate through the system. And that's why I think that, you know, our timing would end up being very fortunate because I think it's the last, you know, 6 months that set up for the great investment opportunities over the next 18 months. Because that's when I think the reality is going to set in, and there will be some really, really interesting transactions available to us. And you know, and not to digress, but there's really a disconnect right now between what the public markets is telling you and what we see in the private markets. And frankly, I see the, you know, the frenzy of activity even over the summer. You know, it strikes me it's more kind of FOMO motivated, so fear of missing out motivated transactions. And, you know, we've always had a very patient approach. And again, that's by virtue of being at the family office and having patient capital. I think that the opportunities will only get better.
And my observation is that you know, when I first launched, I was pleasantly surprised at the number of opportunities out there, and because I didn't expect to see many opportunities, frankly, given the environment we're in. But what I found was a lot of the deals that had started pre-pandemic were still available, and I started to see those. And also, there were a lot of deals I think that were launched in the spring and after July 4th. In many cases by business owners who are so fearful that tax rates are going to increase substantially should there be a change in government, that they were willing to take, you know, a 10, 15% hit in perceived value because they thought that they may take a 20% or more hit in 2021 should tax rates change. You know, I can't predict what's going to happen, but I do know that there has been some tax motivational selling of businesses that's occurring in 2020. And in terms of the effect of COVID, I was interesting to hear what Annette had to say about that, because we're seeing COVID-adjusted EBITDA numbers, and it's impossible to know what's real and what's not, and whether it's truly going to return to 2019 levels. And when I see these COVID-adjusted EBITDA, it makes me smile, because who really knows? But what I've tried to do to protect, if I find a company that's interesting, but it's really impossible to tell how they're going to do in 2020 and beyond, and whether it's truly COVID related, is I try to protect myself by offering perhaps a non-control alternative that's more fixed income oriented, where I'm not taking quite as much equity risk because of the inability to really determine what is real and what isn't. But if I can get an adequate return through a fixed income with warrants or a convertible security that gives me some protection, there's a way to structure around that COVID risk and eliminate some of that noise.
As far as developing the investment strategy, has this pandemic at all affected how you think about your investment strategy or diligence approach? Or is it more of just a short-term thing and you hope that we'll get past this and it'll be business as usual?
I'm happy to answer first there. Ideally, in this environment, because it's so unpredictable, you're going to be attracted to companies that have grown despite the pandemic, and I've seen some examples of that. So I don't know that the diligence has changed, other than to try and figure out, if at all possible, how much of a downfall is COVID related and the likelihood of return to normal. But I think that's difficult. Unless you're a prognosticator, which I don't think we're investors. We're not tellers of the future.
Yeah, and I think in post 08-09, everyone tried to focus on, okay, how bad was the downturn? How recession resilient is this business? I think the new term we're going to start to hear is how COVID or pandemic resilient is this business, and looking at things that either you can get pretty comfortable that it's a temporary dislocation that's caused by COVID, and people will go back to old habits, but that's a hard leap to take. Or looking at businesses that have shown some level of resiliency. I think there are certainly some categories that are going to be hard from an investment perspective that have just been completely shut down, and it's hard to tell how those are going to recover.
Well, I would say that so my partners and I spend a lot of time talking about it, and in my opinion, this pandemic has accelerated time in a way where I do think that there's some fundamental business practices that are evolving as we speak, and understanding how those changes will impact existing businesses, I think, render a lot of the traditional playbooks that a lot of private equity funds employ, perhaps less relevant, right? And I'll give you some examples, right? How do people think about office space has changed, right? Where do you hire your employees in the company has changed, right? And a lot of the truisms that a lot of entrepreneurs held true for a very long time, I think will change over the next 6 to 12 months, and I think it's going to have an impact on how these businesses go forward. And I think that this environment will create the winners and the losers. And I think that as my fellow panelists highlighted, I think that our job is to evaluate that and see how that's factored into a price. Because at the end of the day, the price at which we invest matters a lot, and understanding how that price can earn you a return through some of the business changes that we make as private equity investors, I think is going to matter a lot. And I think new playbooks are being written.
For some of the audience who are considering launching funds, maybe you talk about just
You're not coming in clearly.
Okay.
practically, how should someone budget from a time and cost perspective?
We're missing you.
We can't hear you.
To launching a private equity firm. From our experience, we've kind of historically seen our clients investing. So, how would you? Sorry, is this better?
Now I think we can hear you.
Now I
Yes,
think so. Yeah, I think it was your connection.
Yeah. I was asking from a time and cost perspective to launch a private equity business. What would you advise the audience who is thinking about launching a business? Now, historically, from our clients' experience, working capital investment needs were anywhere from $4 to $6 million to launch a business. How do you see that now in a new environment? As you talked about, Pavel, new ways to, truisms in launching businesses have changed, and that's the same as for an investment business.
I think launching an institutional fund in this environment is extraordinarily difficult. I mean, never mind the expense of it. I mean, just if you can't sit in a conference room with potential investors, unless there's a long-term historical relationship and trust factor, I'm not sure that money is a factor or determinant of a successful fundraise in this environment. But even under the best of circumstances, it's a daunting task to be a first-time fund manager. And unfortunately, as I think we've all experienced, even if you have 20 years of experience at a fund, if you go off and do it on your own, you're considered a first-time manager, even though it's all you've done for the last 2 decades. But you do get put in that box. So my advice to someone who's contemplating doing this would be, unless you have a group of investors or a family office or high net worth individuals that know you well and are prepared to back you, either to be your investor group or to at the very least be a founding investor from which you can leverage to source others. This is not for the faint of heart. I'm not sure I would recommend it, to tell you the truth.
Oh, I would say it's really interesting because it's again not a dissimilar approach to how you diligence a business, right? Before you launch a fund, it's important to come up with a realistic budget, and underwriting that budget, for your team is important. And again, it's no different than diligencing an investment. I think, practically speaking, I think it's important to there are places where you should spend money and get the best advisors, and then there are places where technology allows you to be pretty frugal. And I think that our experience has been that launching a firm from scratch basically allowed us to implement kind of best-in-class technology that made the process of setting up relatively straightforward. And the other thing that's been really helpful to us is there's a whole industry that developed where you can very efficiently outsource a lot of your needs before you end up hiring a whole bunch of people. I think that one of the biggest changes, again, to let's say 5 or 10 years ago, is that there are service providers like Trust Vista who will give you on-demand surge availability of kind of analytics and analyst advice, and you no longer have to start a firm with hiring 10 people, 10 associates and analysts and whatnot. And so in my mind, that to some degree lowered the barrier to entry from practical perspective. And I think that you no longer have to have a physical presence. It became socially acceptable to basically be in a virtual office environment.
Yeah, I think, Avi, to try for us to give you a budget really depends on each manager's investor base and goals. So I do think for any launch, one of the biggest costs is the legal aspect, the structuring and the documentation of it. And obviously, the more investors you have, the more complicated that is, and the more back and forth you're going to have from a legal perspective, and that's where your legal bill really starts to add up. And I think, you know, the other piece of the budget for someone to keep in mind is if you're going to be out fundraising, how much are you going to travel? How are you going to go see those investors? I mean, certainly given COVID, some of that is more limited, but as Michael said, I mean, there's still an element of sitting across the table from people and having investors be able to do their diligence. So I think certainly in any environment, it's tough to come up with a budget without, for any of us, because we know our own experience, but it really depends on how the manager is going to approach structuring of the firm and the fund.
Yeah, certainly, you know, since we started Trust Vista, probably a third of all new clients at any point in time are emerging managers, and part of our existence was to facilitate launching businesses more efficiently. But, you know, as you mentioned, Pavel, this does bring down the cost of launching business and effectively brings down the barriers to entry. So, and longer term, it becomes a more competitive market as more entrants can come in. You know, you don't need to be a KKR to be a private equity investor necessarily. So how do you guys view the future of private equity from a competitive perspective, not just for fundraising, but as actually being able to source and win the deals?
It has become a much more competitive industry than when I started in 2003. That's for sure. And I think it will continue. Look, I think it is a secular shift in the capital base. I think that's part of why we're seeing asset prices not necessarily moderate as quickly as sort of fundamentally one might think that they would. There has been a lot more money pouring into the asset class. There are a lot more global investors putting money behind the asset class. And frankly, there are a lot of family offices that are looking to get direct exposure to the asset class. So this business has always been one where you have to really pound the pavement and get out there and build relationships with entrepreneurs and owners and management teams. But I think that that's going to become even more critical over time as you see more and more firms come up. That said, there are a lot more companies in the smaller end of the spectrum, and so the availability of opportunities to go after is larger in the mid-market and in the lower mid-market than you know, in large scale private equities. I think you'll continue to see sort of a bifurcation in the market, and in terms of the number of managers on either end of the market. You'll see, I think you'll continue to see sort of a few number of very large managers going after those really large businesses, and then a lot more firms on the smaller end, because again, it's just a availability of targets.
And,
Go ahead,
Paul. Oh, okay.
I think it's always very difficult to originate a deal, no matter what the environment is, and I think that's largely been the truism for a long time. And I would say that for RQ specifically, you know, we chose a somewhat unconventional strategy where, you know, we're looking where capital is not. We're looking for capital vacuums, and you know, we made a decision not to participate in auctions and try to remove ourselves from competitive situations, because, you know, it's any competitive dynamic results in ultimately higher price that you end up paying. And so as a generalist, you know, we prefer not to constrain ourselves by a specific sector or size or geography. And it's a lot more labor intensive to do it this way, in my opinion, but I think it ultimately results in a more differentiated return for your LPs, because you really, you know, we ask ourselves the question, why do we have an opportunity to invest, and why other people are unable or unwilling to make the investment, right? And if we can't answer that question, if the answer is just money, then we probably shouldn't participate in that process.
And you know, from my perspective, I mean, there's intense competition in private equity. I mean, I think I saw statistics at last count, there was over $800 billion of dry powder looking for deals. So it is intensely competitive, and there are new firms being founded every day. Look at the three of us. So I think what you have to do is pick your spots, because just participating and being the highest bidder in an auction process is not the ticket to riches. I think we each are trying to find that capital vacuum that Pavel was talking about. In my case, I set my strategy quite simply by making a list on a piece of paper of the reason I lost deals that I liked in the past, and set my strategy to address all the reasons I lost those deals. And the primary factor was due to size, because most of the firms I've been associated with were less inclined to invest in businesses less than 5 million of EBITDA. And I also lost deals because the business owners was loath to have a gun put to his head after 5 years to sell the business, which is the traditional private equity model that I don't have to adhere to with family office backing. And many times I felt like I was trying to ram a round peg in a square hole. I was offering a non-controlled deal and they wanted more liquidity, or I was offering a controlled deal and they didn't want to sell control. So I devised the strategy of doing both. So I think you just have to pick your spots to try and be competitive in an otherwise intensely competitive global market.
Abby, I think you're
Abby,
mute.
we lost you again.
We can't hear you, Avi.
Yeah, no, at this point, I'll welcome the audience to submit questions via the chat. You now? How about now?
Can hear you.
I have no idea what's going on. I was just saying I welcome the audience to submit questions via the chat feature as well. Certainly, as you guys mentioned, it's getting more competitive, but the nature of being labor intensive lends to this being a fragmented market. And certainly more and more businesses are attracting private equity type capital and building themselves to be attractive targets. And as part of this, we see an increasing amount of PE to PE type of transactions, right? Which have always been a thing, but now growing increasingly in prevalence when you have private equity firms specializing in certain check sizes. So sometimes the most obvious buyer for an asset is another private equity firm. Now, how do you guys view this as part of your overall strategy as far as maybe buying from other PE firms or selling to PE firms?
It's a good question. So, in my mind, I think that you need to understand why someone's selling, right? Because I think that a PE firm has perfect asymmetric information in that situation, and you assume that they're rational profit seekers. And I think that there has to be distinct reasons why a private equity is selling a company. And I think that raises the bar for those transactions. I'll be honest with you.
I think the way I think about it from a strategy perspective is PE could be a very viable exit for a lot of the businesses that we're building. So, our express car wash platform is an example of a buy and build where we started small and we've made several acquisitions and continue to make acquisitions to grow that. If we get it to the size that we're targeting, I think there will be a lot of private equity buyers. So certainly the way we're thinking about it is much more from an exit opportunity perspective than necessarily buying from another private equity firm. That said, in my past life, we bought businesses from other private equity firms and they were very successful investments. So I'm not opposed to it. I think just more from the lower mid-market size range, it's more likely to be a founder entrepreneur-owned business than a private equity selling to another lower mid-market private equity firm.
I think I would prefer to buy directly from a business owner than from a private equity firm, even though if it's been private equity owned, you know that there are systems in place and there's good governance and infrastructure and financial reporting, et cetera. Whereas sometimes you're looking at a small company with an owner entrepreneur, and it's they're using QuickBooks, and it's it's like one step above having receipts in a shoebox. But so sometimes it's easier to buy a business that's already been professionalized by private equity. But what I've observed is that in general, a private equity firm is seeking the absolute highest bidder, and they'll certainly take into consideration the preferred partner for management. But at the end of the day, they have a fiduciary responsibility to their LPs and are looking for the highest price. So my goal is to convince an owner entrepreneur that I'm going to be a good partner for them to help them grow their business. Everyone has money, but I think at the end of the day, business owner is also looking for someone who understands their business, who they believe can help them grow, and who they like and who they trust. So my hope and expectation is that I can convince a business owner that I would be a value-added partner to them and help them grow the business, whether I own control or not.
Maybe to close out here, maybe each of you can just spend a minute to maybe give advice to anyone thinking about launching a fund. What's the most important nugget of wisdom you could share?
It is not for the faint of heart, and it is a lot of work to be an entrepreneur. I'm having a lot of fun and really enjoying it, but I'm also working harder than I've ever worked in my life, and that is saying a lot because I have worked really, really hard. For anyone who knows me and has worked with me in the past, I've always been an incredibly hard worker, but being an entrepreneur, you have a never-ending to-do list, and it's on you and your partner and no one else. And so you really have to be prepared from a professional perspective, but also from a personal and life perspective, and say, is this the right time for me to do this, and consider sort of all aspects, because it is, as we talked about at the beginning, it is different than when your sole focus is on finding investment opportunities and getting them executed, and monitoring. You've got to do all that, and plus all the firm operations and beyond. So that would be my biggest piece of advice, is make sure you're sort of prepared for that type of commitment, both from a professional and personal perspective.
So I would say that something that we mentioned earlier, I think that my advice is, if you're going to start this venture, do it with reliable and tested partners. I think it's going to help you a lot. Spend a lot of time budgeting and preparing yourself for the launch, because in my mind, it's a preparation game, and the more you spend up front, I think the easier the process is going to be. Be prudent about how you spend your money. Try to pick advisors that understand you and that you're important for them. Don't rush to hire people, because I think that as a new enterprise, it's really important the first couple of hires that you make. And don't be afraid to use outsourced service providers, because in many cases, instead of reinventing the wheel for yourself, you can actually get much more cost-efficient and, frankly, better work product by using the right partner, whether it's on back office or front office.
Yeah, and I agree completely with what Annette and Pavel shared. The only other piece of advice I could give is strategy and messaging. If you're looking for capital and you're just another middle market private equity firm or buyout firm, you're not going to get noticed. I think you really need to have a differentiated strategy. Whether it's focusing on a sector where you have specific industry knowledge and a network of contacts, or operational experience, but I think you have to have an angle, because just another mid-market buyout firm is not going to get much notice. So I would focus on strategy and messaging that strategy appropriately to prospective investors.
Great advice, and thank you all for taking the time to speak with us today. And TrustVista is very privileged and excited to be your partners at the start of your journey, and hopefully in a few years we can do the same panel again and look backwards and see how wise our wisdom was. Wonderful.
That's a
Thank
deal.
you to our audience for participating as well. And if you'd like to speak with any of our panelists or follow up with TrustVista about how we might be able to support you, please feel free to email us at reachus@trustvista.com, and we'll follow up as soon as possible. Thank you all and stay safe.
Great.
Thanks.
Thank you.
Thanks, everybody.